High interest rates, recession, inflation, war. Everybody thought 23 would be a catastrophe for investors. Well, turns out we're halfway through the year and it's not too bad, right? So the question I'm asking you today is, should you wait until the market crashes before you go in, or should you always stay invested? Dividend growth investors, bonjour. My name is Mike Leroux and I'm the founder of Dividend Stocks Rock. I'm also a passionate investor helping you invest with more conviction so you can enjoy retirement. And today we're going to talk about a lot about that conviction that you need, that confidence in your strategy and the stocks that you do and the money that you put to work to make sure that one day you enjoy your retirement and you don't have to worry about that crazy market going up and down all the time, right? So let's go back in time now and look at this graph for last year of 22, where it was a catastrophe regardless if you invested in the US market or in the Canadian. Even the energy sector was not good enough to save the day. One of the worst thing that happened in 22 was the realization by many that interest rate would continue to go higher and higher. And I know it's kind of hard to believe, but I keep telling you, in 23 it's going to be the same, and this is what's happening. Obviously, it's not going that high anymore, but still that spooked the market, and a lot of investors decided, you know what? The market is down double digit and I could earn easily 5% on certificate of deposits or GIC. And then you're just thinking, well, I'm going to go for the safe option at 5% and I'm going to forget about the market. Now, fast forward to this beginning of the year and then you're just like, why in the world I decided to follow my instinct that were driven by fear, thinking that a 5% yield was the best thing I could do when the market is up double digit in the US side. Obviously, if you were Canadian, you probably made a good pick because you're pretty much like half and half. But if you're like me, you invest half of your portfolio on the US side, the other half on the Canadian one, and then you are smiling. So if you go on my blog, the Dividend Guy blog, you'll see that I report my pension account. That pension account, the beauty of it is it's a Lira account, which means it's a locked-in RRSP. What does that mean? It means I cannot add capital into that account. So the growth is only coming from the stock returns plus the dividend. So no more added capital. I cannot boost those returns by any ways. And as you can see on that blog, I report it monthly. And for the first 5 months of the year, I am up 10%. I'm not telling you that to brag. I'm just telling you that to put everything under perspective, where a lot of investors thought 5% interest guaranteed on a GIC was the best move they could make for 23. Well, it happens that most dividend growth investors are averaging double-digit returns since the end of the year, which is awesome. So why so many people went to those GICs? Well, what we fear is actually what happened during the financial crisis of 2008. So as you can see there, total return for the S&P 500 and the total return for the TSX hasn't been great. I mean, we're talking about 5 years and less than 1.5% annualized growth rate. You can definitely not retire on that. And this is what you fear. You fear that you're about to retire. You have this huge portfolio that you work very hard for, and then you go into this slug of the market where nothing is happening, and at worst, actually, it's going down for a while, and it takes so long to recover that during the meantime, you're withdrawing money from a portfolio that doesn't generate anything. But now here's the question. Should you wait until that drop finally happens, since what we saw in 2009, and then start investing at that point, where a lot of investors tell me, yeah, I'm going to wait until I see that the interest rate has been plateaued, or maybe that there will be an interest rate cut, that the central banks are telling me that inflation is under control, or I'm waiting for the Fed's next decision, or I'm waiting for companies to tell me that everything is going to go right, or I'm following a bunch of other financial indicators. But here's the thing. Let's go back in time again during the crisis of 2008. As you can see, the perfect bottom was in March of 2009. If you invested in November of 2008, you were pretty close to it. But if you add that crystal ball, you would have invested in the bottom of the March 2009. It took about 3 years to recover if you had invested at the peak. So you can imagine how much profit you would have made in 2009. Actually, roughly 26, 27%, almost 30% if you had bought the bottom all the way to the top of that year. But here's the thing. Imagine that you go back in time. So you're in 2009, in March. It is the bottom, but you don't know that yet, right? So you just say, okay, so I'm going to look at indicators. So you look at the US GDP growth. Well, going nowhere for a very long while. And then it started to increase a little bit more around 2011. So you've been waiting like at least good 2 years before you invest. No indicator that the market is going back into a bullish economy in terms of the recession, going out of that where consumers want to spend. Well, you know what? You look at housing starts, because housing starts is going to tell you a lot about the economy. Well, that's been lagging. Like nothing is happening in 2009, 2010, 2011, 2012. Very bad indicator telling you you should probably not invest right now, right? So you're going to say, okay, so the economy is not growing, housing starts are bad, I'm going to look at unemployment rate. Then again, unemployment rate, super high, and then starts to go down in 2011. So long story short, if you have waited in 2009 to have clear indicators that that was the time to invest, well, you were waiting for 2009, 2010, 2011, and potentially 2012. Because remember what happened in 2012, you might have forgotten, but that was the year where the pigs, Portugal, Italy, Ireland, Greece, and Spain were all on the verge of bankruptcy. Their bonds interest rate were super high, and everybody said, you know what, that is the end of the Eurozone. So again, probably didn't invest in 2012. So those are like 4 years of amazing return that you have completely wasted based it on the fact that you were waiting on economic facts to tell you that you were right, and also based on the fear of losing money. So what really happened there is the market is forward looking. So while you are looking at stats are telling you what happened before, not what's going to happen in the future. So while the market was thinking, oh, here's going to happen in the next 2-3 years, you were looking at here's what happened in the past 12 months. And that creates a huge discrepancy, and that most likely going to jam you into paralysis by analysis. So then you're gonna ask me, well, Mike, what is the solution? Like, how can I move forward and move and invest that portfolio, right? Well, the easy answer is stay invested, but the real solution is to invest with conviction. How can you do that? Well, first you need a very strong strategy. You need a strategy that you believe. It might not be the best, it might not be the one that beats everybody else, but it has to be the one that convince you that investing is a good thing. For me, it's dividend growth investing. Why? Because every time I look at my portfolio going down, I instead look at my dividend payment, and those dividend payments are going up. Like this year, last year, the year before, the next year, in the next 5 years, it's always going up. Why? Because I select companies that are growing their dividends. So that helps me, that enables me to see the confidence management has in their own business, to see that while the stock price goes crazy, the business is still making money because of the fact that they are able to increase their dividends. So it's a perfect sign that I know where to go. If you want to know more about this strategy, I have written a complete recession-proof workbook. We're going to do a deep dive into all the sectors. We're going to look at different strategies, and I'm going to share with you my buying process. The best part, completely free. So just go down here at dividendstocksrock.com/workbook. So you get the link. There's a link description below as well. So dividendstocksrock.com/workbook. You just put in your email. You're going to download the complete new version, 2023 version of the Recession Portfolio Workbook. So I hope that you have enjoyed this video. Give me a thumbs up. Don't forget to follow me. And next Thursday, we're coming up with my Smith Maneuver update. So don't forget to stay invested.